Hey everyone! Have you ever wondered how to start building an investment portfolio? Well, today we're diving right into how you can create your first investment portfolio, focusing on a strategic approach known as the core satellite portfolio. This concept could be a game changer for your financial future. We will break down everything from choosing investments to keeping track of them. Whether you're a beginner or looking to refine your investment strategy, this video is packed with valuable insights. Let's start with the basics. What is a core satellite portfolio? The core satellite portfolio strategy is a popular approach to portfolio construction that aims to balance the benefits of passive and active management to minimize costs, tax liability, and volatility, while also providing an opportunity to outperform the broad stock market as a whole. Imagine your investment portfolio is like the solar system. The core, which is 70 to 80% of your portfolio, consists of ETFs, or exchange-traded funds, acting like the sun, stable, consistent, and central to your investment universe. The core of the portfolio is made up of passive investments that track major market indices like the S&P 500. This part is designed to provide stable, long-term growth with low costs, as passive investments typically have lower fees than actively managed fund. The core usually comprises a large portion of the portfolio, providing diversification and reducing the impact of individual security fluctuations. The remaining 20 to 30%? Those are your satellites, individual stocks selected to potentially increase your portfolio's return. The satellites are actively managed investments that aim to generate higher returns. These can include individual stocks, sector funds, alternative assets, or any investment that you believe has the potential to outperform the overall market. Satellites make up a smaller portion of the portfolio and are selected for their potential to add value through superior returns. Now, why does this matter? Using ETFs for the bulk of your investments helps in reducing risk through diversification while allowing room for growth through selective stock picks. The core investments help to keep costs down because they involve less frequent trading and therefore incur fewer transaction costs and capital gains taxes. The satellite investments allow for strategic positioning in sectors or assets that may be poised for growth or income, providing the potential for higher returns. By combining the stability of the core with the growth potential of the satellites, investors can aim for overall portfolio performance that beats the market while keeping risk and costs under control. Let's break down the steps for setting up your core satellite portfolio. First, choosing the right ETFs. Look for ETFs with a broad market index like the S&P 500 to start with. An example could be Vanguard's VOO, which tracks the S&P 500 index. For example, say you're 35 and have $1,000 invested in VOO. Imagine you continue investing $250 into the fund every month for the next 30 years. At age 65, you'd end up with more than $500,000, assuming the S&P 500 keeps up its approximate 10% annual growth. For an even broader reach, there is Vanguard's VTI, which takes in the entire U.S. stock market. Check the fees, usually referred to as expense ratios, and opt for low-cost ETFs to keep more of your returns. Next, picking individual stocks for the satellite portion. Focus on industries you understand or find promising based on current trends. Consider the health of these companies, such as their profit margins, revenue growth, and free cash flow. Use financial news sites or stock analysis websites like Seeking Alpha or Stock Analysis, which is a free site, to gather quality information. Now, diversification. Apart from just mixing ETFs and stocks, diversify within these categories. Choose ETFs covering different sectors and geographies for diversification. For stocks, spread your choices across various industries to mitigate risks if one sector performs poorly. Monitoring your portfolio is crucial. Regular monitoring and rebalancing are essential to ensure that the portfolio maintains its intended risk profile and that the satellite investments are performing as expected. Set a routine, maybe quarterly, to review how your investments are performing. Look at both the performance and how it aligns with your financial goals. Adjust as necessary, perhaps rebalancing from stocks to ETFs if your appetite for risk changes. Consider utilizing tools and apps that allow you to view all your investments at once. Set alerts for significant market movements related to your investments. Remember, the key to a successful investment portfolio is starting with a solid plan and continually managing it. The core satellite portfolio strategy is about creating a solid foundation with passive index funds and then adding actively managed investments as satellites to seek additional growth opportunities. It's a dynamic approach that leverages the strengths of both passive and active management styles. If you found today's video helpful, smash that like button and share it with someone who could benefit from these tips. Don't forget to subscribe for more useful content like this. Thanks for watching, and I'll see you in the next video where we'll dive deeper into maximizing your investment returns safely. Keep investing smartly and let your money work for you.